In this recording, let's work a problem related to entries for zero interest bearing notes, notes payable. So the example we'll use is exercise 1316 out of the textbook, the CASO textbook. So let's take a look at the problem, note some facts, and then we'll solve for the questions. It says, on January 1st, 2025, Carter Company makes the following two acquisitions. Number one, we purchase land having a fair value of $200,000 by issuing a 5-year, zero interest bearing promissory note in the face amount of $337,012. Interesting dollar amount. Number two, purchase equipment by issuing a 6% 8-year promissory note that has maturity value of $250,000 and interest is payable annually. Our effective interest rate for our debt is 11% related to other funds from the bank. So our instructions, we'll round everything to the nearest penny. Part A, we want to record the two journal entries related for Carter for the two purchases on January 1st. And in B, we'll record the interest at the end of 2025 for both the notes using the effective interest method. Okay, so let's go back and make a few notes here on our in Excel. So the first thing is the date. So they're both done on the same date, and that's 1/1/2025. For number one, let's see, one has land with a fair value equals $200,000. It was done with a 5-year note, zero interest, that has a maturity amount or face amount of $337,012. And then for number two, we have equipment. Let's see, we do not know its fair value. We know that it is an 8-year note. It carries 6% interest, and it has a maturity value of $250,000. And we also note for this note, interest is payable annually. The last piece of information we have is that the company has to pay 11% interest for funds from a bank. Okay, so our let's see, we are Carter standard borrowing rate is 11%. All right, so the land is at 0%. Seems like a good thing. However, we're getting a $200,000 piece of land, and in 5 years, we have to repay the note of $337,000. And then the equipment, we don't yet know its fair market value, but that note is only 6%. And then again, that final comment says that our typical borrowing rate for funds from our bank is 11%. Okay, so with these facts, let's move down now and begin our journal entries. So the first one let's work on is the land, number one. Okay, so these are dated on January 1st, 2025. And we know we're going to have a debit to land. And then we're going to have a credit to a notes payable related to the piece of land. All right, so let's work on the debit to land. So if we look back at the facts of the problem, we see that the land had a fair value, and that's the amount we're going to record it in the books for, of $200,000. And the notes payable is the amount that we owe. So on January 1st, 2025, when we acquire this, we sign a note and we have an obligation to pay $337,012. However, there's a discount. And this discount is equal to the difference between the amount of the loan versus the fair value. That's going to effectively be the interest that we're going to amortize, or the amount we're going to amortize towards interest throughout the 5 years of this note. And so that difference is $137,012. To double check that, The problem did not ask for this, but I will show you how to double check these amounts. So in this case, let's find the present value of our note. So the present value, we always record interest and do these calculations based on the market rate. Even though we pay interest based on the stated rate, we're going to calculate interest expense and adjust the corresponding discount or premium based on fair market value interest, the effective interest rate. So we have our effective interest rate is 11%. And then our number, how many years do we go out? We go out 5 years. I'm not looking for a payment. I'm looking for the future value. And the future value is 337,012. I want to know, what is that today? What is $337,012 backed up 5 years at 11%? So that one cash flow stream that occurs in 5 years, what is that today? What is that cash worth today? And it's $200,000, the exact amount that we recorded as the fair value of the loan. So a little trick here, I don't know if it's a trick, a clue that we could look at. Why is this notes payable such an odd number of $337,012? Because that's what makes the $200,000 work for land. So we've confirmed through our present value calculation right here that the land is in fact worth $200,000. And that corresponds to what the note suggests with an 11% effective interest rate. Okay, so there's our journal entry to acquire the land. Let's now move to record the purchase of the equipment. So we'll have debit equipment. We don't know what that dollar amount is. We'll have, again, a debit discount on notes payable. And then we'll have a credit to notes payable. We do know what the notes payable is for in this one. It told us that we have a note has a maturity value. So in 8 years, we have to repay $250,000. But we also have to pay interest on this loan. So we want to know, similar to what we did above when we verified the $200,000, I also want to determine what is the fair value of the equipment on the date we acquired it. So let's do a couple of present value calculations. So the present value, again, we're going to take our present value, our rate is 11%. How many years? This one, we're going to back up $8,000. And what's the amount I'm going to back up? I'm going to back up $250,000. So I'm going to assume today, what is the cash equivalent to $250,000 with 11% interest in 8 years? How much is that cash today, the present value? And it's $108,482. But I also have an interest payment stream. So let's see, what is the present value of our interest payment stream? The same 11%. How many interest payments do I have to make? It says it's an 8-year note and interest is paid annually. So I have to make 8 payments, 8 of them. What is the amount of the payment? Let's see, the amount of the payment is $250,000 times 0.06%. That's the stated rate. And I believe that's $15,000. We'll double check that in a minute. I'm not worried about future value. And then the payments come at the end of the year. We don't make the interest payment on January 1st. We make the interest payment on December 31st. So my annuity is going to be the 0 end of the year. And I get $77,192. So we said $250,000 times 6%. That would be our interest payments, and I believe that's $15,000. So we can go in here and drop that $15,000 and just to verify we get the same number. So we have to make $15,000 interest payments, 8 of them, considering the effective rate of 11%, interest paid at the end of the period, $77,192. So if we add these together, we get a total fair market value of $185,673. And just like before, the difference between the value of the note and the fair value of the asset gives us our discount of $64,327. That is how you record the journal entry for part 1. Now let's look at part A. Part B says record the interest at the end of the first year on both notes using the effective interest method. Okay, so we are now at December 31st, 2025. And we're going to record the interest. Let's start with the land. So we have interest expense, and we will slowly amortize that discount on notes payable. And again, this one's for the land. So let's start with that one. Okay, so our net amount that is owed, let's add that right here. Our net amount that is owed is $200,000. So our net payable for the land is $200,000. And we're going to amortize that at 11%. So our net payable for land is $200,000. And we're going to use the effective interest rate, which was given to us as 11%. And so our interest expense is $22,000. And we'll have the same amount that we'll credit to the notes payable discount for land. And then we have the same journal entry for the equipment. Let's see, what is its, let's just go ahead and add that formula in here. So the net amount of the note payable, that's what we're trying to get towards, times 11%. So the net amount is notes payable minus the discount, net of the discount or premium. In this case, it's a discount, so I'll subtract it. And I get $185,673, which we confirmed a moment ago because that's also the amount that we purchased. This only works in year 1 because in year 2, we will have already amortized some of the discount. So this amount of 185 only equals the cost of the equipment for year 1. After that, we begin to amortize it down. All right, so our discount then, we're going to multiply it by 11%, just like we did before. All right, so that is based on 11%. However, we know we have to make a cash payment, so stand by on this amount for a moment. We have to make a cash payment, so our interest expense is not just simply the amortization, it's also going to take the amount of cash that we have to pay. And we found that a minute ago to be $250,000 times 6%, which was $15,000. So in our journal entry, the amount that we pay on let me start that sentence again. The amount that we pay for cash interest is the stated face amount of the loan, which is $250,000, times the 6% stated rate. And that gave us $15,000. And then we're going to adjust that towards interest expense as we amortize the discount on bonds. I'm sorry, the discount on notes premium. If it was purely no interest paid, then it would be the full 11%. However, because we were having some of this is paid in cash, the true amount that's adjusted to the amortization for the amortization of the discount on notes premium is $5,424, which means the interest expense is equal to those two numbers. So let's go over this last journal entry again, what's happening here. When we're recording, let's address both of them. Let's start with the first one. So in the first one, as it relates to the land, we do not have any cash payment. Therefore, everything is all the interest is being captured inside that discount on notes payable. And we can see how large that is compared to what it was for the equipment. This is about twice as large. And so all the interest is held inside of the discount on notes payable. And we're going to amortize that through interest expense as we go throughout the term of the note over 5 years. The discount on the notes payable for the equipment is much less, even though the loan is longer. And that's because we're going to have to make cash payments throughout the year. So the discount is not as large because we're going to make cash interest payments as the year goes along. So if we look down at our interest expense journal entries, the land interest is all held inside of that discount on notes payable, and that discount will be amortized to interest expense as the term of the loan proceeds. And we calculated the net payable to be $200,000, and we took 11% of that. We got $22,000. There's no cash paid, so there's no credit to cash for the land. And then we record a debit to the interest expense for $22,000 and a credit to the notes payable for $22,000. For the next one, for the interest expense on the equipment, we have to make a $15,000 cash payment every single year for 8 years related to the note for the equipment. So therefore, we got $15,000, and we calculated the amount that should be recorded as interest as $20,424. Let's do this calculation a different way. We said that the loan was $250,000. Minus the discount, so I can get the net amount of the loan is $185,673, and multiply that by 11%. I get a $20,424 interest expense, and so therefore, again, the net amount that for the amortization is $5,424. So at this point, this does conclude the requirements for the problem. However, you're welcome to stop now, or you can continue to watch. And what we will do is we will do the 8 additional journal entries for the equipment loan, so we can see what happens there. So this is in year number 2. We're going to debit interest expense every year, and we're going to credit the discount on notes payable for the equipment, and we're going to credit cash. So we'll see what happens as this loan progresses. We know it's always going to be a $15,000 credit to cash because that's what we're required to pay. What we don't know is what's going to be the interest expense for each year and the corresponding amortization of the discount on notes payable. Let's see. Our interest expense is going to be calculated based on the original amount of the loan minus the portion of discount on notes payable attributable to this loan minus what has already been amortized. And let me correct that because that's actually going to be a plus. So I've got the original amount of the loan minus the original amount of the discount on notes payable, and I'm adjusting for that for whatever has already been amortized. So 5,424 of the 64 has already been amortized. So I'm really only looking at about, what's that, 59,000. So this number should be around 195, 191. I'm going to prove that. Minus, this has been the total amount of amortization, and this amount is how much has been done before. Let's do this differently. Let's make this ultimately easy. Let's draw us a T account. So bear with me here, and we're going to set up a T account. Okay, so we have a discount on notes payable, and we started with 64,327. And then, so this was when equipment was purchased. And this is amortization for 2025. And we arrived at that amount was $54.24. Therefore, the balance of the discount on notes payable for the equipment at 12/31/2025 is $58,903. So to be able to find my interest expense, I take the amount of my loan, which is $250,000, minus the balance of my discount on notes payable, and I multiply that by 11%. So my formula is the balance of my loan, the face amount of my loan, $250,000, minus the discount on notes payable for the equipment, which is $58,903. Multiply the result of that subtraction by 11%, I get $21,021. And therefore, just like we did before, my amortization of the discount on notes payable is the difference between those, which is $6,021. And this is the amortization for 2026. And math for that will give me the balance at December 31st, 2026. So you can see we're slowly working our way towards zero on the discount on notes payable for the equipment. Let's just go ahead and fill this T account in. Well, let's see. Well, we're going to need to do those calculations. Let me drop in the next row at least, and we'll continue to work our way through it. So next, we're looking for the amortization for 2027 so that we can find the balance. So we need to know what is this cell right here. We're looking for this balance. So we will copy this journal entry down and we will solve it for 2027. All right, so our loan value, face amount, minus our amortization from the prior year, net discount on notes payable, leaves us $197,118. So that's the net amount of the loan, the face value net of the discount. And as before, I'm going to multiply that by 11. And I get $21,683, just like we did before. Net that against what was cash paid of $15,000 for interest, leaves me with an amortization of $6,683. Proceed to the next year, 28, 29, and then we'll move into 2030. And how many years is that? 1, 2, 3, 4. Let's see, this is the end of 1, 2, 3, 4, 5, 6. Need 2 more for 8 years. 7. And then 8. So there will be our 8 years. And we'll copy this on down 8 times. And we'll see what our balance is at the end of the period. Okay, let's do our journal entry for 2028. Our interest expense is always the face amount of our loan, which is always $250,000 in our example through all 8 years, net of the balance of the discount or premium on notes payable times our effective interest rate, since we're using the effective interest rate method. And that's 11%. So we get $22,418, net that against the cash paid, And we get $7,418 as amortization for December 31st, 2028. Moving to 2029. Our face amount of $250 minus what was the balance of our amortization at the end of the prior year. Multiply that by 11%. Calculate the difference. $8,234. You can see, we'll examine the T account when we're done. Let's go ahead and finish our calculations. All right, that was 29. Let's do 30. We'll do 30. Interest expense is calculated as face amount, net of premium or discount, times the effective interest rate, which is 11%. And we get $24,140. Net that against the $15,000 cash paid means our amortization is $9,140. Great. Couple more years to go. Face amount minus the balance of the discount. Net those together and multiply it by our effective interest rate, 11%. We get $25,145. Net against the $15,000 cash payment means the amortization is $10,145. And we have 1 year to go, which is 2032. So let's do that last amortization. At December 31st, 2022. So our last one, this is also when the note is due. We get $250,000 minus our carrying value of $11,262. As always, multiply it by the effective interest rate, 11%. We get $22,261. Net those two together against the cash, and you get $11,261. So amortize the last amount, $11,261. And let me shrink that just a little bit. And let's look at what's going on inside this discount on notes payable. You can see it started at $64,327, and we calculated that earlier in the problem. And then we're going to amortize that over the course of the loan. We know that at the end of the loan, it's going to be zero. We're left with $1 down here at the very bottom, and that's due to rounding. But the essence of the problem shows us exactly what's going on inside of this account. So we're amortizing it down every year, slowly towards zero, based on the effective interest rate. It's not a straight line. It's not consistent every year. It's increasing because the amount of the interest expense, the cash paid, is becoming a smaller proportion of the actual interest expense. And we can see that based on the net there as it relates to what interest expense is compared to what the cash payment is in our journal entries that we recorded above. And so this column F represents interest expense for each year. And this column represents the amount that was paid in cash as it was compared or related to the amount of amortization of the discount. And note that T account that it ends up effectively at zero at the end of the 8 payments of interest at the end of the 8-year term. We could do this for the same for part 1 related to land. It's the exact same result, except the journal entry does not have cash being paid. It is purely just the amortization. And so that should also amortize over the course of 5 years. If we were to do this journal entry, calculate this journal entry just like we did with the equipment. If we did this 4 more times for the total of 5 years, we would find that the discount on notes payable for land would also work its way towards zero over the course of the 5 years. And we'll do the process exactly the same. So with that, I will conclude the example of working exercise 1316 from chapter 13 of our textbook.